Hello, today we have Erika Murphy with 18 years of investment experience. Erika is a portfolio manager at Fidelity in the Global Institutional Solutions Group. GIS is a multi-asset investment team, and in her role, Erika manages custom multi-asset class mandates for institutional investors. Before Fidelity, Erika was an MD at Wellington, where she held a similar role, designing and managing custom multi-asset, multi-manager portfolios for large institutional clients globally. She also played a key role in Wellington's sustainability and climate research initiatives. Earlier in her career, Erika worked as an investment professional at GAM's Hedge Fund of Funds, and she served as an analyst with Ernst Young's valuation advisory practice. Erika has her CFA and CAIA. I know we're going to have an interesting conversation because Erika works across strategic allocation, tactical asset allocation, open architecture, building blocks, including active, passive, traditional, and alternative liquid and illiquid strategies. And her investment process draws on the breadth and depth of Fidelity's macro, quant, technical, fundamental, and manager research resources. So I love that. Erika, welcome today.
Thank you very much for having me.
You know, obviously we have a lot of wood to chop this year, and given the broad scope of what you do, maybe we start with macro dynamics. How would you characterize your team's views currently and looking through 2023?
Okay, so just for context, when we express our active asset allocation views, we are taking in a variety of different inputs, and all of those are calibrated to a certain risk level. So when we think about our active asset allocation risk, we're typically overweighting or underweighting within a constrained risk budget. And I give that context because today we are running at a lower risk budget than we typically would, and that's to reflect the uncertain market environment that we're operating in today. In my view, we are in an unprecedented monetary policy experiment, and we don't quite know the effect of this tightening environment that we've been in. It's historically unprecedented given how rapidly we've seen rates increase in recent months and quarters. And so as a result, we are more cautiously positioned at the aggregate portfolio level. So for example, our overall portfolio equity beta is roughly neutral, and our duration exposure also is roughly neutral. But if you were to look under the hood and kind of look in the intra-asset exposures, we are taking much more divergent views with regards to regional exposure. So we are very underweight U.S. equities, and we are overweight non-U.S. equities. And that's to reflect the view that we do think that there's more downside risk, there's more recession risk that's still to come in the United States, but we have more room we have more recession risk priced into non-U.S. developed equities as well as emerging market equities, where we're starting to see some more constructive signals from a fundamental and policy and valuation perspective as well. So, that's just within equities. And then from a fixed income perspective, we're roughly neutral on the surface, but with regards to how we're getting there, we have been very underweight duration for almost the last year. And that's just recognizing the challenging environment given rising rates. We've been lightening that and have actually been adding to long duration bond exposure. We've been adding to cash exposure. We've been avoiding high yield and leveraged loans exposure. Again, that's mostly focused in the United States here. And that is to reflect the fact that we do think that we are in a period of elevated recession risk. And we do think that those, longer duration instruments might serve a better hedge going forward. And then lastly, because we are multi-asset and we get to invest in other asset classes as well. From a commodity perspective, we have been, I would say, going back to late 2021, we had a more favorable view on commodities and inflation-related assets just in general, given the fact that we believe that inflation would exceed market expectations, and we do continue to believe that we will see structurally higher inflation than the market might anticipate, and yet we have been, we have seen the deceleration in recent prints. We are seeing sort of rates start to come off of our inflation rates start to come off of their peak. And as a result, in a more tactical fashion, we have been paring back our exposure. So now today we are sitting at a much smaller commodity exposure, again, to reflect the more structural view, but to be more cognizant of the shorter term risks as inflation starts to decelerate. So that was a lot there, but that's generally our positioning today.
And so what I hear from you is that basically, you were positioned right and not having the long duration and then probably being more in the U.S. In the more recent history, but then now, so call it 2022, but now you're like bringing back that long duration because we're at the end of the rate hiking cycle. It seems to be what you're saying, and you're more worried about the recession risks, basically the economic risks here, which will be slower GDP growth. Which obviously then affects the fundamentals of businesses, meaning you don't want to be in those equities. They're probably overvalued here in the U.S. and you're going to be able to, make money on that long duration side because you don't see a lot of, even if inflation is sticky, the rate cycle being more hikes that are going to, damage those security values. You're thinking, okay, it's the opposite end of the spectrum, which is we'll start to see that long duration pay off, which has been happening lately, of course, with tech being up, and then treasuries, obviously, with yields coming down. And do you take that kind of view in a very short term? Like, do you have a short term, intermediate term, long term view? Or when you're thinking about the risk budget and your positioning, what's the duration that you're looking at to make those exposures?
Great question. So we do have an expression of long-term investment allocations, and that comes through our strategic asset allocation. So that is something that we review on an annual basis, but it's making 10-year asset class projections and return and risk projections. And so that's our long-term view. We have our tactical views that are honestly, they bring together a variety of different views. We have some shorter-term quantitative signals that are reading momentum signals. We have some more medium-term business cycle signals, and then we have some longer-term valuation signals. And so when you put all of those together, I would say maybe our views that certainly don't have high turnover, they tend to stick, but you could sort of see them come and go year in and year out at that frequency. But typically our views are a mix of the shorter and longer-term views, and then how we express it gets constrained by our risk constraints. It sort of will ebb and flow as we see strength of signals change over time.
And the other kind of interesting thing and by the way, we have a really similar process. Like, I don't know what you do day to day, but it's similar, from a big picture. So I get what you're saying. But when maybe let's unpack the equity piece, because obviously you can look at fundamentals. So are there certain geographies that are going to have better fundamentals or economics, from a GDP acceleration or deceleration of growth, or levels of inflation, what's baked into valuations? But is currency, does it depend on your view of the dollar or the local currencies as well? Or is it much more about the GDP or inflation of a country?
It's much more about I would say we have a three-pronged process. So we look at business cycle, which is very much the economic fundamentals. It's more the GDP side of the equation. That's a big driver of our positioning. We also then take into account valuations and momentum. The currency impact ends up translating into, over time, it translates into momentum most quickly, and then the business cycle fundamentals sort of secondarily, valuations. I suppose if you see a sudden change in currencies, you can see it start to come through longer term valuations. But for the most part, we are judging economic fundamentals first and foremost, and then layering in those other dimensions to make sure that we have a fully painted picture, make sure we understand the different drivers of potential risks and return. Did that answer your question?
Yeah, no, that's helpful, I think, for folks who, whether or not they have a similar process to you, but just thinking through where does currency boil through in the process, that it gets taken into consideration. And maybe also just kind of staying high level on the process is that hopefully you're always right? The strategic moves are always right, and the view is on the very short, intermediate, and long term. But sometimes things happen, like the speed of China reopening can dial up or dial down things, right? So how tactical can the portfolio moves be? And thinking through a year like this year, what would make you shift your exposures? Are there certain kind of like, it's when a number of factors we're tracking change, or, what makes you guys say, uh-oh, we got to shift here. Something new came into play, just like, the invasion last year. Obviously, people might have shifted some of their exposures. Like thinking through 2023, do you guys highlight for yourselves what could shift those exposures?
Yeah, absolutely. So our process, we're bringing in a lot of different disciplines. So we bring in macro research, we bring in quantitative research, technical research, fundamental research, manager research. We have all the researches. But when it comes to big inflection points, this is where our discretion comes in more strongly. So we're sort of leaning away from our quantitative signals and leaning, sometimes even leaning away from the more shorter term momentum signals, and really focusing on the fundamentals and spending time with our bottom up specialists who help us with understanding the future, perhaps instead of looking at historical return patterns. We can actually speak to those who are speaking with company management teams and out in the field and get their view of what might be different in the future, including a geopolitical analyst who can help us get our hands around the Russia-Ukraine situation, China, all of the geopolitical risks that exist today. So I guess when it comes to these major market events, we take them on a case-by-case basis, and it's really just taking the information that we have at hand at any given time and testing if that information would change the inputs into our investment process.
Got it.
And if that's the case, I guess our first step would be to take down risk. The second step, again, would be leaning on those subject matter experts who are closest to the issues, and sort of taking it from there. I don't want to say that there's any one way that we would handle it, but we certainly have the ability to be dynamic, to adjust our exposures quickly. We're not flipping our positions week to week. We're typically, fine tuning our views on a monthly basis, but you're not going to see something that is a major 180 absent something major happening.
Sure.
Yeah.
And, the other interesting thing, because some people are, purely active, purely passive, but you're balancing passive with active. Maybe explain to folks, how do you do that? Where does it impact your portfolio the most?
Right. And so the active and passive decision comes in mostly in our strategic asset allocation. So this is when, so my job is to help institutions, endowments, foundations, defined benefit plans or state pension plans with their strategic asset allocation, their dynamism, their manager implementation. And so sometimes we do that for a sliver of their portfolio. Sometimes we do it for all of their portfolio. But in any case, when we are strategically designing their mandate, we are typically looking for areas in the market that we believe is inefficient. And in those situations, we will try to pursue active managers. And one of the great fortunes of my job today is that working at Fidelity, we are open architecture. It's not like every organization out there. I have the benefit of a 50-person manager research team. We can really look across other asset managers. And if we find a manager that we think can outperform passive benchmarks on an ongoing, consistent basis with a repeatable process, that's a situation where we would tend to be active. But we're not active for the sake of being active. We're active for the client's benefit. And so, we really have to believe in that outperformance. And so you'll tend to see us favoring active in small cap, in emerging markets, in high yield, and some of the sort of plus sectors within fixed income, for example. But we're going to be passive mostly in large cap equities, and we're going to be passive in sort of our long duration and our tips exposure. So, we do pick our spots.
Mm-hmm. And one of the things I like to learn from great investors is how they define risk. And you've talked a little bit about having a risk budget. Maybe you can explain to folks, what does that mean? How often do you set that? You said, you can dial it up, dial it down. You're on the lower end of that risk budget right now. Just maybe bring to light a little bit about what that means at Fidelity.
Sure. So in a multi-asset portfolio context, there are so many different risks that you have to try to control. The first and foremost, the biggest one for clients and that we have to sink our teeth into is the strategic risk, right? If we get the strategic asset allocation risk wrong, that's the moment where our clients are falling short of the endowments annual spending target, or the liability hedging. And so that's the biggest risk that we're trying to mitigate. And around that, to try to mitigate that risk, we try to bring in two sources of additional return to try to diversify the strategic asset allocation risk. So we do that through active asset allocation and security selection. And we give ourselves risk budgets. How much risk, how much should we be tilting away from the strategic allocation to lean into asset classes that we're favoring, or that we think are less attractive today. And we give ourselves exposure constraints, but we also give ourselves a tracking risk threshold that we're not supposed to go outside of. And again, that just gives our clients comfort that we're operating within a risk managed approach. And we do something similar within the active risk, the security selection side of the equation as well. We look at security selection and active asset allocation. They tend to be actually pretty lowly or negatively correlated. So one will zig and the other zags. But collectively, we're looking at what is the strategic allocation risks. That's the biggest one. And in doing so, what are the major drawdown sensitivities? What are the Achilles heels? What types of market environments won't that work? And then we try to layer in diversifiers through that risk constrained, that tracking error constrained active asset allocation and security selection. So that's sort of
sure. Yeah, I think that's helpful for folks, is just to say, like, well, how are you thinking about risk, and then how is it affecting the portfolio from a big picture perspective, and then your implementation of it, whether it's security selection or that strategic allocation, vis-a-vis the objectives of the client that you're dealing with. Which is, I'm sure you've had a million client conversations in the past few months, as well as in the past few weeks, maybe around the banking crisis. It'd be helpful for folks to hear, what are people's either biggest concerns, or what are the questions that they're asking you that you're tasked with answering for them?
There are 1,000 concerns. I say that sort of glibly, but at the same time, I think the biggest risk right now is, are we at a moment when the Fed is going to start to pivot from its prior policy path? So we've been, again, in a very unprecedented period from a market's perspective, where we saw inflation surging, and policymakers responded, but their tools have not been all that effective in taming the inflation dynamics, nor sort of normalizing the employment picture. And so, up until just a few weeks ago, the markets were thinking we were on a higher for longer path until we saw something, quote unquote, break. And maybe, I don't want to say that this is the moment where things are starting to break, but the Silicon Valley Bank incident, for lack of a better word, might be the point where we start to see a tightening in credit conditions. It might be the catalyst that triggers more, more joblessness, so, a higher unemployment rate. We don't know yet. It's too soon to determine that. But certainly, those are factors that the Fed is considering in making their decisions on whether to continue to hike, pause, or ease. And so that's the biggest, hardest one to get our heads around. There's a lot of team debate right now happening in terms of how things might evolve going forward. But what's ironic, what happens in the economy also doesn't necessarily translate into what happens in the markets.
Yeah, that's what I was going to say. Our house view is that credit is tighter. It's going to get a lot tighter. Right? There's going to be more defaults. Actually, I showed a chart on Bloomberg today about, basically people's credit card loans, and they're through the roof. But you're right. The question is, then do people get excited because then the Fed's not going to keep raising rates, or are people going to freak out because it means the economy and the labor markets are going down the tank?
Right. And so there could be an equal risk of being underweight. Even if we think that we're on the brink of recession, there could be a risk of being underweight, or too underweight. And that's the reason why our positioning is somewhat constrained. Yes, we are underweight U.S. equities, but we are, not at a fully maximum risk underweight. And that's just to be cognizant of that risk should we see some sort of a reversal. And we are also sort of sprinkling in, within US equities, we're very underweight US large cap equities, but we are favoring smaller cap equities. And that's, again, it's based on fundamentals. It's based on how they perform in, structurally higher inflationary environments relative to larger cap equities. We're trying to pick our spots where we think we see more tailwinds,
Right.
And we are trying to listen to the headwinds.
Right, sure.
But we certainly aren't taking a maximum conviction view today.
Well, this has been fascinating. I'm sure people might have questions for you. They'll get in line after your clients. But last but not least, how can folks find you, Erika, to either, keep up to date with whatever your allocation is? I don't know if you ever give that out, what you're personally doing. How do people get in touch with you?
Yeah. So, Fidelity has an institutional presence, and so we have our own website for those institutions. So institutional.fidelity.com is sort of the first place to look for our market views. Mm-hmm. And also to sort of, if anybody's interested in learning more about Fidelity or our team's investment process, we're certainly happy to share, and we could connect through there. Alternatively, if it's appropriate, folks are also willing that are willing to reach out over LinkedIn. Happy to have those discussions as well.
Well, thank you so much for sharing your time with us today. I certainly enjoyed hearing about how you guys put all of those things together to help your clients out. So again, thank you, Erika.
Yeah, thank you very much. I appreciate the time.